Good morning or good afternoon. We are going to wait 1 or 2 minutes for some people to join, and we will start in about 2 minutes. Good morning or good afternoon from wherever you are in the world today. Welcome to the Norexeco webinar, Understanding Financial Instruments for North American buyers and sellers of pulp. Norexeco is the world's only internationally regulated market for trading pulp and paper derivatives. First, I'm going to introduce our speakers today, and you should see their pictures up on the first slide. Patrick Cavanaugh will be first. He is the senior economist for Fast Markets RISI, and he will review global pulp markets with the impacts on North America specifically. Next, Carl Tonsberg, Norexeco's portfolio manager, will discuss ways to leverage Norexeco's expertise and ways to handle financial hedges. Next will be Gurinder Dugal, who will review strategies for determining when and how to make decisions about commodity pulp explicitly and how to explicitly trade pulp. Lastly, I'm Miles Cohen, host and moderator for today's session. Next slide, please. I'm a senior executive, been a senior executive for 2 of the largest pulp and paper manufacturing companies in the world, serving as president of both companies. In 2021, I formed a packaging and sustainability recycling advisory firm, Circular Ventures, and became Norexeco's North American consultant earlier this year. Next slide, please. All participants, everybody will be muted. There's a Q&A box to enter questions, and all Q&A will be handled at the end. And if you do put in a question, I am advising you that we will not reveal your name or the name of your company. Next slide, please. And with that, I'm going to introduce our first speaker today, Patrick Cavanaugh, senior economist for Fast Markets RISI. Patrick?
Great, thank you, Miles. I appreciate that. So, I guess we'll get started on the next slide here with an overall view of the pulp market. One more slide, please. So we're looking at 175 million tons of pulp consumption last year globally, and this is a number that has fluctuated relatively little over the past 2 decades. Even less than 1% growth on average. For market pulp, however, this is a different story. We're looking at a growth rate about 4 times that, and now last year we're looking at 70 million tons of global market pulp consumption. And again, just showing how much larger growth potential for market pulp compared to integrated pulp. Next slide, please. In terms of where all this market pulp is being consumed and how it's being consumed, on the left-hand side, we see a regional breakout of market pulp consumption. The Chinese market, 38% share in 2021, by far the largest consuming market for total market pulp, even larger, for example, than the US and Europe combined. That's been the case for some time now, and it will certainly remain the case in the future as well. In terms of how market pulp is consumed by end use, on the right-hand side, We can see that there are three major end uses here: graphic papers, tissue, carton board, and specialties. There are different cross currents for demand in each of these markets. However, last year, tissue actually lost some market share due to destocking that occurred following a very big year for production in 2020. The opposite was true for graphic papers and cartonboard and specialties, which bounced back strongly following a down year during the onset of the pandemic. Next slide, please. So in terms of how we're looking at our latest macroeconomic outlook, for the United States, we've actually lowered our projections, and that's the case for many of these other regions. We're looking at just 2.3% growth this year, followed by 1% growth in 2023. This is really, again, front and center inflation, weighing on demand, really central banks in the U.S. and also in Europe, raising those key interest rates, trying to rein in inflation, but hoping to do so without triggering a very large recession. So right now, if Miles, you could hit the next few slides, we can get the rest of these regions showing. This is our rest of our macro outlook. Chinese growth really hindered in 2022 by the recent lockdowns. And we're looking for a bit of a snapback in 23 at 4.6%, but again, not very strong, certainly compared to the snapback witnessed in 2021, for example. Europe continued to face several headwinds, especially related to the war in Ukraine, but perhaps 0.5% of growth next year. Latin America already decelerating quite strongly from the recovery in 2021. And next slide here to show the global forecast, 2.4% in 2022, and a slight improvement to 3.4% in 2023. So our current view is that while the global economy faces headwinds, we do believe that there will be a soft enough landing for ongoing support for market pulp consumption next year. Next slide, please. Another indicator for demand that we track closely here are the purchasing managers indices. There are two shown for China. Again, just highlighting the importance of this market. In blue and purple, we saw a strong snapback for these PMIs, which anything over this red line is indicating expansion in the manufacturing sector, and anything below that line is the opposite, showing contraction. So following a strong snapback in late 2020, the Chinese economy has been decelerating steadily, including very little growth really in the manufacturing sector since the second half of 2021. The most recent round of lockdowns triggering a sharp contraction. Now, again, I think these PMIs will certainly bounce back. There will be a recovery in China in the coming months. But I think the question of how strong that recovery is really going to be key to the demand side of the market pulp price forecast, especially in the coming months. The global PMI shown here in gray, also facing steady headwinds and on a decelerating downward trend. Next slide, please. So where do we stand in the current state of market pulp prices? We're in the midst of a historic run here. We're showing NBSK net import prices in China in purple here, plotted against the Norexeco NBSK SH contract, which is tracking that BSK contract in the Shanghai Futures Exchange. Now we can see how this futures market played an important role in the current bull market. We have arbitrage opportunities driving the futures contracts higher, especially starting in late 21, right up through the first quarter of 2022. That upward pressure really was pushing import prices higher. More recently, the past 2 months, that dynamic has shifted. We can now see that the BSK contract is falling well below import prices in US dollar terms. And again, now we have the opposite happening. Without that arbitrage opportunity, there's quite a bit of downward pressure in the short term on softwood prices in China. Next slide, please. Another aspect on the supply side, which has really driven market pulp prices higher, especially in the first half of this year, is unexpected downtime. Instances of labor strikes, major equipment failures, and transportation shortages, all leading to less availability of market pulp. In fact, there was a record amount of unexpected downtime in the first quarter. This is the case for BSK and also in the North American market for northern bleached hardwood kraft, both registering record high volumes out of the market in the first quarter. We believe that in the second quarter, we are seeing an easing of unexpected downtime, but however, there are been some new instances occurring. But the UPM labor strike in Finland has been resolved, and that is by far the largest component of the first quarter record high unexpected downtime. Next slide. Logistics constraints remain especially relevant. In the Chinese market here on the left-hand side, we're demonstrating this with this map showing that during the midst of the lockdown, especially in Shanghai, there was quite a large buildup of vessels off the Chinese coast. Now we're seeing, with the reopening in China and Shanghai especially, we can see more and more pulp being offloaded from those vessels into Chinese ports. On the right-hand side, we're showing in the first 2 weeks of June a record high volume for pulp inventory sitting in ports. So again, another indicator that with a larger amount of volume heading into the Chinese market, that there could be an inflection point here in the short term. Next slide, please. The regional differences between market pulp prices, even the same grade in two different regions, is also extremely relevant. With China being incredibly important in terms of just the sheer volume of market pulp consumed, it has an outsized influence on other regions and prices for pulp in those regions. This slide demonstrates the relationship between NBSK prices in the U.S. on a net basis versus in China also on a net basis. And we can see how in periods when strength in China develops, it does influence prices higher in the United States, and the opposite is true on the downside of the market. Now, we've seen increased volatility here over the past 18 months. And again, these relationships have held true. However, with logistics constraints, there's also a delay in how quickly market pulp shipments can be diverted from one region to the other. And that's also leading to more volatility. The most recent development here shown through May shows that once again, prices in the Chinese market have risen above the United States, and that's placing upward pressure on softwood prices in the United States, again, in the short term. Next slide, please. Another spread that's incredibly important and relevant to keep an eye on in the pulp market is the difference between softwood and hardwood. We've seen overall the investment cycle focusing more and more on new market pulp capacity in Latin America, especially on the hardwood side. There's just been a sheer abundance of BHK compared to BSK, and that's led to record high spreads developing in terms of softwood minus hardwood, reaching up to $250 per ton, and also lasting for an extended period of time. We can see that in the past, there's been a very kind of consistent and reliable cycle between softwood and hardwood prices. But again, this relationship has decoupled to some extent due to, again, just the less availability of softwood overall compared to hardwood. And we believe that that's something that could develop into a higher average spread between softwood and hardwood in the longer term. Next slide, please. And a final point here on cost inflation, which has been relevant to any good in any industry, but also especially for market pulp. Increases in energy, chemicals, labor, and especially transportation costs have really pushed cash costs higher, especially over the past 3 to 4 quarters, especially. So when this becomes most relevant is actually on the down cycle of the market, in terms of establishing where that price floor, the next price floor will fall. This is also relevant in terms of the softwood market being much tighter and much more affected by less investment and more unexpected downtime as well. So when we're looking forward to this inflection point in pulp markets, it's now become more and more relevant to think about cost inflation. Where does the new price floor? Yeah, this is coming from our mill intelligence service, which provides mill level data on exactly where these pressure points are. And that concludes the market pulp portion. I thank you for your time.
All right. Thank you, Patrick, for that market update, and thank you, Miles, for the introduction. So my name is Carl Tunsberg, and I work as a portfolio manager here at Norexeco. So I'm going to give you a fairly high-level introduction to Norexeco. I'm going to talk about the benefits of trading on an exchange. I'm going to talk about the using pulp futures and how you can implement those commercially, usage of pulp futures contracts. So this is going to be very high level. So I'll assume some of you will have knowledge beyond the topics I'll touch upon here. And obviously, if you want to discuss anything, then please reach out to me and we can have a one-on-one discussion to discuss any specifics. All right. So Norexeco, this is a long one. We're a regulated commodity derivatives exchange for the trading of pulp and paper futures. Now I'm going to break that down a little bit more. So in 2012, our current CEO, Stein Ole Larsen, together with a consortium of investors from the forest industry in Norway, they came together to establish an exchange for the trading of pulp and paper futures. In Norway, we are a transparent economy. We have transparency, we have good regulation, and we have an economy that to a large extent is based on the export of natural resources like energy. And we also have a history of exporting high quality fibers. So to us, it made sense that an exchange for pulp and paper derivatives could be in Norway. And in 2014, we got our license from the Norwegian Ministry of Finance. And Norway is what we call an EEA member. So we are an associate member of the European Union. That means that in Norway, we adopt all the financial regulation and directives that comes out of EU. That also makes Norexeco a regulated market. And being a regulated market in Norway means that we are supervised by the Norwegian Financial Supervisory Authority. And to build a well-functioning derivatives exchange, you need a couple of partners. So Norexeco, early on, we partnered with Fast Market for indices. We partnered with a technology provider for the provision of a trading system. And we partnered with the European Commodity Clearing House. And together, at that point, when we went live in 2015, we were able to provide a complete structure for trading commodity futures on exchange. Right. So Norexeco, we bring together market participants from all over the world. And those market participants, they are producers, they're buyers, they're banks, brokers, and they're traders. And common for all of these participants is that they believe in the advantage that a regulated exchange brings to the market. I just listed some of those advantages here, and I think one of the key features of a well-functioning regulated market is that it allows you to grow liquidity. So when different participants with different trading interests come together in one order book, it just creates volume. It makes it easier to transfer risk, and you can transfer that risk at the lowest possible cost. There's a saying in markets that liquidity breeds liquidity. So once you have a certain level of liquidity in an order book, there's really no reason to go anywhere else if you're looking for a counterparty to your trade. When you have liquidity and transparency as you have on exchange, then you have another benefit. And it is that you can bring together participants to form the consensus price for the future price of a commodity. So if you have sufficient participants coming together, then that transparency allows the market to see where the market as a whole expects prices to trade in the future at any given point in time. And as any market participant, being in the industry or otherwise, you can then use those prices for, well, you could use them for planning, you could use it for budgeting, you could use it for contract negotiation, or you could use it for financing purposes. When you trade on an exchange, you trade anonymously. So in our order book, no one can see who the resting orders are, and no one can see who trades. So that also means that you don't have counterparty risk to your counterparty. Everyone has one counterparty, and that's the European Commodity Clearinghouse, ECC. So by removing the counterparty risk, you open up an environment where more counterparties can trade against each other, which again grows liquidity further. And then secondly, and this is a little bit more complex, but when you have liquidity grow on an exchange, it means that it becomes easier and easier to trade in and out the risky position. And via different mechanisms, this results in lower implicit trading costs, which all participants can benefit from. Now, Norexeco, we're proud of our strategic partners, and we believe that they provide us with a strong setup for growth. I already mentioned ECC, which is central to our model, but we also have a partnership with Fastmarkets. So Patrick represents Fastmarkets, and Fastmarkets, they are the most relied on price assessment provider in the industry. And at Norexeco, we use those price assessments and that's the Fastmarkets indices to settle our financial contracts. So this means that even though our contracts are financial and there is no physical delivery, and I'll talk more about that later, it still connects with the physical market via the assessments that Fastmarkets collect. It connects with the physical market on the settlement stage. Then we have a partnership with the Shanghai Futures Exchange. And the Shanghai Futures Exchange, they listed a softwood contract a couple of years ago. And that has been very successful in domestic China. I think in 2021, they traded some 1.2 billion tons of softwood contracts. And that's a massive multiple on the underlying. Now, that market isn't readily available for international participants. So by partnering with them, we've agreed to establish a separate international order book. And by doing that, we've opened the route for international participants to tap into some of that liquidity. And lastly, we have a partnership with the Freight Investor Services, FIS. Now, FIS is an interdealer broker, and they have a proven track record of building liquidity in derivatives markets. Example of that is the iron ore market, where they played an important role. And then I'm going to talk a little bit about what a financially settled futures contract is. And we know that derivatives can be complex, and to some it could be a little bit scary. But it's important to keep in mind that a lot of people, most people and companies use some sort of derivatives in their everyday life. An example for private people is when they fix their interest rate on their mortgage. What they're doing is that they're entering into a swap agreement with your bank. Another example is when you insure your house. You're basically entering into a fairly complex put option with your insurance company. Similarly, even fairly conservative companies would use derivative contracts for many purposes. They could fix or float their interest rate. They could use it to hedge their currency exposure, to hedge input costs like energy or pulp, or they could use it to secure margins on what they sell. So we believe that financial pulp and paper futures are fairly simple to understand. And just looking at the slide here, a pulp future is a derivative. It means that its value is determined by the price of an underlying asset. And in our case, those assets is the index, which links to the physical market. They are forward contracts. They have the same features of a forward contract in that they are an agreement to buy or sell an asset at a specified time at a specified price. But they are not forward contracts, they're futures contracts, which basically means that it's an exchange traded forward contract where the terms are standardized and it has daily mark to market. So having daily mark to market means that any profit loss is settled by the clearinghouse and it's sent to the buyer of the seller contract on a daily basis. You don't build a large debt or a large gain or loss that has to be settled at the very end, at the settlement time. They are financially settled, which means that there's no physical settlement. So at the time of settlement, you don't have to bring any commodities, any physical pulp to a warehouse, nor can you collect any physical pulp from a warehouse. So on the below left side, there's a table, and that's basically how we display prices in our different products. So these are different prices for the different for some of the contracts we have. On the right side, I've included a graph showing the softwood Europe contract. Now the solid line are historical settlement prices. This goes into the dotted line, which is where the market anticipates that that price is going to be in the future. In a very liquid market, that will be a very exact line. So this graph is some days old. It will have shifted today. This is from the 21st of June. But as you can see, the market is anticipating the price of softwood in Europe to fall starting, August, September. We're saying that the market is in liquidation. We've also included two graphs showing the average level. So we have included, for instance, how 2023. You can see the graph is dropping towards that level. That's the average price on the 21st of June that the market thought that all the months of 2023 would trade at for this product. So these are the ways you could use the market to predict or to get an understanding of how the other market participants are predicting prices in the future. Now, a diversity of market participants on a regulated market just reflects the many ways that they can use futures. So I think at the core of any successful exchange is the fact that you have natural buyers and sellers with natural risk. We're looking to hedge that risk. In other words, they're looking to lock in their price exposure at some future time. Then you have the speculators. Now, speculation is basically making a directional bet on the underlying. You think that the price the market think will be there for next year is too low. Well, you can buy the contract, and you're speculating that when we get to the settlement date, the price will be higher. Then you have the arbitrage trade, which is basically betting or identifying price differences to two markets that you believe to be aligned. And in theory, a pure arbitrage trade is a risk-free trade where you make a profit by aligning those two markets. In other words, you make a profit by removing any mispricing. And lastly, you have, or there's many other ways, but another example is the company looking to modify the risk exposure. So let's say you're a seller of pulp, but the buyer, and you want exposure to the pulp price. You want market price exposure. But the buyer wants to insist or would like you to fix the contract against them, commercial contract. You could offer a fixed price, but then you can turn around in the futures market and you could buy a financial future. And that way, even though you're providing the service of offering your counterparty a fixed price contract, you still have a floating cash flow with the same risk exposure as in the line. Now, currently we have 6 products listed at Norexeco. On the left side, it's the European contract. It's a softwood euro contract traded in dollars. The hardwood euro contract traded in dollars. These are all fast market indices based on fast market indices. And then the recycled paper contract is the all corrugated containers 104 priced in euros. Gurinder will later talk more about how North American participants can use these contracts to hedge their risk based on your exposure. Then we have, particularly on the right side, there is the Chinese contract, and we are in dialogue with primarily North American producers who are looking to use these contracts to hedge their price exposure when exporting into the Chinese market. We have a softwood China contract that's it. We have a hardwood China net contract, and we have a replica contract, which is based on the contract that CPS listed, the Shanghai Pulp contract, which is priced in US dollars and where we've subtracted the Chinese VAT. So these are the 6 products, but each product has 14 contracts listed. So we have 2 upcoming years, 6 upcoming quarters, and 6 upcoming months. What does that mean? It means that first upcoming year that we list is 2023. If you buy that contract, you buy the average price for the full year. Similarly, if you buy 2024, you buy the average price for 2024. You can buy the average price for third quarter 22, or you could buy the average price for the upcoming month, July. So all in all, we offer at any given time market participants to lock in prices for up to 36 months. And, yeah, these contracts settle monthly. That's detail we could get into at a later point in time. Now, on Norexeco, the trading occurs in an electronic limit order book. So we offer a web-based user interface that allows any direct member to log into the interface and place orders in the order book or on the screen, as we say. Now, these orders are firm. So any order resting in our order book can be executed or taken out by another trading member, right? Since they're firm, they're sent directly to the CCP, the clearinghouse, for trading and then for settlement. And using our system, we offer multiple different order types. We have different risk management tools. And at all times, trading in our market is supported by the Norexeco Market Service Desk. So if any problems occur, if you need any assistance, there's always someone on hand to answer your questions or help you with those orders or execute those prices on screen. In addition to this, we have an app, a phone app, which also allows members to track market prices. And lastly, this is just a slide saying market structure, but really talking about how you can access our market. So as a North American client, you have many options. You can, in some cases, trade directly on the exchange in your own legal entity. Some companies will use their European subsidiary if they have one. Or you could trade indirectly through a third party. A third party on the exchange that would allow that sort of trading would typically be an international investment bank or a broker. There are many options, and if this is of interest to you, I suggest you reach out to us so that we can discuss what option would work best for you.
Thank you, Carl. Gurinder?
Yes, Miles. Thanks, Miles. Okay, hi, I'm Gurinder Dugal from Simplex Management Consultants. Today, you all just heard from Patrick about the pulp market conditions globally. You also heard from Carl about the Norexeco products and the capabilities. Today, I'm going to cover the procurement risk management, hedging in specific, and we will share some few examples to showcase how Norexeco's products can be used by US-based companies for financial risk management. Next slide, please. Yeah, next slide. Yeah. So, who is Simplex Management Consultant? Consultants We are a procurement and supply chain consultancy and have extensive experience of working in industries such as paper and pulp, CPG, cement, chemicals, energy, and commodities. We focus on cost leadership and surety of supply, and we cover all elements of procurement and end-to-end supply chain. Next slide, please. You are all very well aware of the commodities market. The inflation which we are witnessing for the past 2 years, and pulp has not been an exception either. We have seen fluctuations of up to 80% in most cases in the last few years. The question which we have is, how do we manage this cost and the market uncertainty? How do we deal with it? And we will showcase, we will take a look at few commodities inflation examples to showcase how the markets have been behaving in the past few years. We have seen the same from Patrick as well. Next slide, please. So if you look at this chart, you see that oil, we have the energy over there, which is almost 77% up in the last 2 years, since January 20. You can see the agriculture products all being in the high, 50 to 100% price increase. And if you look at pulp, it's all between 50 to 71% price increase for NBSK, BHKP, and fluff pulp. So how do we operate in such unpredictable times? No one could have predicted this high levels of inflation which we are witnessing right now. I think it's probably the highest in the last 40 years. And this inflation does have a very big impact on the P&L of most companies. So what do we do about this? Not doing anything is an easy way out, but a more strategic approach is to do something about dealing with dealing with the high inflation and the price increase. So the question at the end is, can we mitigate some of the risk which we are witnessing? Can we mitigate some of the price increases which we have seen in the last few years? If yes, then how do we do that? Next slide, please. So this is one of the this is the input estimated input cost of coated paper. As you can see from the pie diagram, that energy, which is approximately 16% of the input cost, is the most commonly hedged commodity, but it's not the highest input cost. Whereas fiber, pulp and fiber, which is 58%, is the highest input cost, but the least the least hedged commodity. And the reason why we are showcasing this to all participants is so that you guys can take a good look at your input cost breakup. Think about this. You have the highest input cost of pulp, which is not being hedged by a lot of companies, whereas energy, which is just 16%, is being hedged by a lot of companies. It's very obvious that to manage the market volatility, we should have done, we should have hedged pulp a long time ago. Most companies should have done this instead of just focusing on energy. Next slide, please. Let's take a look at the first example we have, which is the NBSK US. As you can see the cycles very clearly in this diagram, and you can also see the price movements. Since between August 17 and November 2018, we saw a 30% price increase from a base of $1,100 per metric ton. And similarly, between August 20 and June 21st, we saw almost 43% price increase from a base of $1,130. Now, for most companies, the question is, are you able to pass on 100% of cost variation to your customers? We believe that most companies are not able to pass on most of this cost increases to their customers. They might be able to do in some proportions. Next slide, please. So how can we hedge NBSK US? We did the correlation between NBSK US and NBSK EU, which is fixed. And we found that since January 20, the correlation stands at 97%, which is, it can't get any better than this. And the correlation since 2016 stands at 94%. So if any company who is buying products with which has got an input of NBSK US, they can basically use Norexeco NBSK PIX to hedge the commodity NBSK US in the US market. Next slide, please. The other example is the mixed hardwood kraft for the US market. Now, again, here we see the cycles of the product, hardwood kraft over the years. The price between December 16 and December 18 increased by almost 48%. Similarly, between September 20 and June 21st, we see a 57% price increase from a base of $860 per metric ton. And what we normally see is that with such high cyclic price movements, traditional strategies and tools cannot help you manage your input cost alone. You need some financial risk management running in parallel to manage your cost. Let's take a look at the next slide, please. Let's take a look at how we can hedge the mixed hardwood kraft. Once again, we ran the correlations between the mixed hardwood kraft US and the northern bleached hardwood kraft picks for the Europe. And we found that the correlation between January 20 and December 21 stands at 98%. And between January 16 and December 21, it was 95%. So these correlations have been very consistent. We can go back, 10, 15, 20 years. We find that correlations have been really good. So for any company which is in the US has got an input, raw material as mixed hardwood kraft, can basically use Norexeco BHKP to hedge their mixed hardwood kraft in US. Next slide, please. Let's look at the commodities which can be hedged. So on the left-hand side, we have the Norexeco products, which Carl mentioned some of these products in his presentation. So we have the NBSK Europe and Shanghai, and similarly we have BHKP Europe and Shanghai, and then under recover paper, we have OCC 1.04. Now these Norexeco products can basically help you hedge or enables you to hedge what we see on the left-hand side, on the right-hand side, which is the NBSK US. We can hedge fluff pulp, non-wovens, tissues, dissolving wood pulp, graphic papers, and all container board grades can also be hedged. And all of these products which you see on the right-hand side basically have very good correlations with the Norexeco products. So the question we often get asked is that how can a US-based company take advantage of this? So they can either register directly with Norexeco, or they can go via their banks, financial institutions to hedge their pulp and paper products. Next slide, please. So the big question we have is why hedge? If you all remember the pie chart we showed you earlier, which was the energy being around 15–16% of the cost and the pulp being over 55% of your input cost. So it's very obvious from the cost breakup that pulp should be hedged. It should have been hedged even before energy. Some of the other advantage we believe hedging can bring is the cost revenue predictability. It helps you secure margins and gives you a scope for better pricing solution for your clients. So we believe that the risk management solutions, especially hedging, does not remove 100% of the risk, but it helps you soften the inflation which we see in the market. And how can we help? So we at Simplex Consultants help companies develop their hedging strategy. We sit down with your team, we do a risk assessment and find out what is your risk appetite. We understand how much we discuss and plan how much to hedge, whether it should be fixed or variable volumes, and when to hedge, whether to hedge on a regular basis or only to enter the market on an opportunistic basis. And what we also believe that there's a lot of market intelligence available, especially the intelligence coming from fast markets, RISI. They are very up to date in terms of the intelligence they provide. What's important is to connect the dots of the intelligence and to transfer that knowledge into a good hedging strategy. And that's what we at Simplex help you guys do, which is basically develop a good hedging strategy. Next slide, please. So we have picked up two examples here, why hedge two scenarios. If you look at the left-hand side, top, the NBSK example, the graph. So what we are basically saying here is that that's how the NBSK US has been moving over the years since January 16. We have put into red lines, and the area between the red lines is that if you have a good hedging strategy, you are able to have your input cost or manage your the NBSK cost within that band. You will not hit the high. At the same time, you will be at the lowest or slightly above the lowest level, depending upon what strategy you have in place. We have also showcased here some of the green lines, which is basically when to enter the market, when the markets are looking volatile, or when it's the green lines are basically good places to enter the market for the NBSK US product. Now on the right-hand side, the mixed hardwood kraft graph which we are showing, this is basically the second example, basically is to help you understand how hedging helps you maintain your profit margins. So suppose in January 2016 or mid of 2016, you enter into when the price was around $850 US, you enter into a sales contract with a selling price of say $1,250 for tissues, and you have a margin which is the initial red line over there. And as the market evolves, you see that your margins keep on fluctuating depending upon what the input cost is, which is the mixed hardwood kraft. So by hedging, you are basically able to secure, because fixed price contracts, when hedged back to back, secures your profit margins. So these are two examples to show, or two scenarios to show why you should be hedging for pulp and paper products. Next slide, please. So what is the hedging process? So we have a documented process to hedge, and we have been using this with other companies successfully within paper, pulp, paper, and other commodities. We have done with metals as well. It's a rigorous process. We have done it for energy as well. It's a rigorous process which we have been using for years. We completely understand the market uncertainty, and we work very closely with both your procurement and the finance team to make this work within a short period of time. We believe that this process can be completed within 2 to 3 months of time frame, and any company which is not hedging pulp right now will be ready to enter the market in 3 months' time. Next slide, please. So these are our contact details. For North America, we have Mr. Miles Cohen as a contact, and for rest of the world, we have Anita. And you can contact us at Simplex Management Consultants of the given details, the email and phone number.
Thank you, Gurinder. Very good. And thank you, everybody. If we just stay on that slide for a minute, and then we'll get all our pictures up. We do have quite a few questions. So there are the contact information for everybody. And if you need Gurinder's or Patrick's, you can email me or Anita, mc@ext.norexeco.com or as@norexeco.com, or you can certainly give me a call as well. The first question, and really thank you to all the presenters. We stayed right on time, and it was really, I think, valuable information for a lot of people. Carl, I'm going to ask you the first question here. It has to do with Latin America. And the question is, and there's actually two questions. So I will ask both of them at once, a question and a follow-up question. The attendee has said, I work in a financial consultancy and support industries in the pulp sector. I see little action by Norexeco in South America to support companies in hedging. Why don't you partner with regional banks to expand your service? And then the second question from somebody else is, there's little pricing information and access to information in Latin America. Carl, can you address that, please?
We do have a South American clients trading in our market, and that market is also supported by some of our brokers. So I think in this specific case, and again, market data as well is widely available. Anyone can at least have access to the delayed information and our weekly report. So I think for that participant, it would make sense for us to have a discussion with them to see if perhaps we could provide them more information in terms of which options they have to access our market and how we can make sure that they get the information they need.
Okay, thank you, Carl. Cara, while I have you on screen here, I'm going to ask the next question to you is, I don't think we handled it too much, is what are the costs associated with trading on Norexeco?
The direct cost that you pay to Norexeco is 0.5 euros per traded ton. So that's per ton per month. And then there's a clearing fee of 0.1 euros. But most participants, if they're not a big bank which has a clearing bank already, they'll need to enter into a clearing bank agreement. So there'll be associated costs. And the same applies if you trade on market through a third party, then you need to enter into some sort of agreement with that bank or broker. But the base cost is 0.5 euros per ton and 0.1 for clearing.
Okay, thank you. And again, if anybody has questions about that, you saw Carl's email address, you can just contact him. Patrick, with respect to the Russian invasion of Ukraine, what are some of the potential impacts for the pulp market?
So I think there are probably three major impacts due to the Russian invasion. One is just the cost inflation that we're seeing, especially in the energy side. That's certainly relevant, especially for European pulp producers and paper producers that are more exposed, especially to natural gas. There's also the European import ban on not only paper but also pulp and pulp wood coming from Russia. So that's created a bit of a tightness there in the domestic market, and especially for the hardwood fiber, birch fiber, especially for Nordic producers, they're going to have to look for alternatives. And then finally, on the investment side, in terms of where new market pulp capacity is going to emerge from, Russia seems a lot less likely without Western investment, but then also the major equipment suppliers for the pulp and paper industry are located in Western Europe, no longer going to do business in Russia. So that really does take quite a bit of potential new capacity expansion, especially on the software side.
Thank you, Patrick. Carl, is there a separate agreement with the clearinghouse that's required to trade on Norexeco?
There is a requirement to enter into an agreement directly with the clearinghouse, and then typically also with the clearing bank of your choice. There is a packet of onboarding documents that any participant needs to go through, but we're supporting that process for anyone that applies.
And Gurinder, Carl talked a little bit about this, but does hedging impact the physical volume transactions for a company at all?
No, it does not. So what we do is basically your supply contracts, your physical volumes being sourced from your suppliers, everything remains as it is. This is an exercise which runs in parallel to your existing contracts. So it doesn't impact, and it's only a financial transaction. It doesn't impact your physical volumes in any way. And neither do you have to disclose your hedging strategy or that you are hedging to your suppliers in most cases.
Okay, and Patrick, what are some of the near-term upside and downside risks for pulp prices, other than the Ukraine-Russian situation, which you just addressed a minute or two ago?
Yeah, I think all eyes now are on the demand side with all the pressures that consumers are facing with inflation, and also as China emerges from lockdown, just how strong can that snapback be in China. So there's definitely a lot of risks on the downside in terms of demand. On the upside, unexpected downtime is always the wild card. That could really restrict supply. And we've seen certainly the emergence of new variants that have severely disrupted supply chains, especially with zero COVID policy. So that's definitely remains an upside risk.
Okay, well, that's the end of our questions that we have today. Is there anything else that any of the presenters would like to make in terms of closing remarks? Thank you very much. Okay. Thank you for attending, and please feel free to contact us for anything.
Thank you, Miles.
Thanks, everyone. Thank you.